Alright traders, as you might be able to tell, I am enamored with the Japanese trading techniques. After all, they have invented the candlestick charts, Ichimoku Kinko, and also the Heikin Ashi candles. Our main focus today will be on the Heikin Ashi candlesticks, which were developed in Japan by Munisa Homa in the 1700s. The Heikin Ashi method, Heikin means average or balance in Japanese, while Ashi means foot or bar. The candles are constructed using 2 days of price data and combining them into one average candle. The main concepts with Heikin Ashi is that they define the trends at one glance, much like Ichimoku defines the bias at one glance. They also help eliminate market noise, which helps traders make a better decision when entering a trading opportunity. Heikin Ashi also helps you to get into a market with momentum rather than entering too early. During a strong bull market, we see strong green bullish bars with no lower shadows, and during a strong bear market, we see red bear bars with no upper shadows. Size of the Heikin Ashi candles is also important, as a larger body indicates a stronger trend. Narrow Heikin Ashi candlesticks with both upper and lower shadows are known as dojis, or spinning tops, much like normal candlesticks. These HA candlesticks indicate the consolidation and possible reversal of the current trend. The calculation of HA, each bar is averaged using 2 bars. Heikin Ashi close is the average of the open, high, low, and close for the current period. Heikin Ashi open is the average of the prior Heikin Ashi candle open plus the close of the prior Heikin Ashi candlestick. Heikin Ashi high is the maximum of the current period's high, the current Heikin Ashi candlestick open, or the current Heikin Ashi candlestick close. Heikin Ashi low is the minimum of the current period low, the current Heikin Ashi candlestick open, or the current Heikin Ashi candlestick close. Bullish candles. When the market is bullish, Heikin Ashi candles have big bodies and long upper shadows, but no lower shadows. As you can see, there's no lower shadows on these big bull candles. And then bear candles, when the market is bearish, Heikin Ashi candles have no wicks above the body. As you can see here, no wicks above the bodies. When the trend started, we had a little wick here, but the rest of these bear candles have no wicks above their upper bodies. And then reversal candles, Heikin Ashi reversal candles look like doji candlesticks. They have no body or very small bodies, but long upper and lower shadows. So there you see these small bodies and no body, but they have wicks on both sides. Look just like regular indecision candles that we see on the normal price charts. So here's a normal candlestick chart as opposed to a Heikin Ashi candlestick chart. You can see it eliminates a lot of the noise, helps you to define the trend. You can see which way the market is definitely going. When the market is green, we're bullish and you stay in your trend, your trade. And then when the market is red, we're bearish and you stay in your trade. So here you see a Heikin Ashi chart again, which shows you that each candle opens on the midpoint of the previous candle. You could see this. Each candle opens at the midpoint of the previous candle. No matter how big or small the candle is, the next candle opens at the midpoint. Alright, so that's one thing, because it's not going to be the same as the price. And then the next thing is, that's how you determine the strength of the market, is basically the bigger the candle, and also just the green candles with the wicks on the top and no wicks on the bottom. But as the market gets weaker, what I like to look at is one thing different that hasn't been really mentioned, but I like to look at where the candlestick opens and closes. Okay, it's going to always open in the midsection, but can it close beyond the previous market close? Alright, so here we have this bullish market. Each candle is closing above the previous candle close. This candle close above this candle close. This candle closed above this candle close, and so forth all the way up. Now here we kind of flattened out. We were pretty much even, but that lets you know some of the momentum to the upside is falling or dropping off. But then we started picking up momentum again. You could see the big candle, but then we had a little bit of momentum loss, a smaller candle, and we closed still above the close of this period. But then this candle never closed above this period. That lets me know the market's getting weak, and then it paints a little doji here. What I like to do is bring my stop loss up below that level. So if I got in the market anywhere down here, I'm going to keep trading, and then when I see this doji, I'm going to put my stop loss below that point. So we'll talk more about that when we look at the charts. So candles of a Heikin Ashi chart are related to each other because the open price of each candle should be calculated using the previous candle close and open prices, and also the high and low price of each candle is affected by the previous candle. That's why a Heikin Ashi chart is slower than a candlestick chart, and its signals are delayed. Therefore, the current price of the market is not always relevant to what the level of a Heikin Ashi candle reveals. Let's look at the next few charts to compare the price of the normal candle opposed to the Heikin Ashi candles. So here we have Heikin Ashi candles, and you can see where the price is based on the red horizontal line that I drew here. But then we look at that same period using regular candles, and we're going to keep that mark at the same level where the Heikin Ashi candle closed. Let's see what it looks like. So you could see the difference. So let's go back. This candle here, the third candle, let's see what it looks like. This is where it closed, but in reality, this is where the market really was. Now, one thing that's true is they both pretty much go to the same height. But look where this candle closed, and look where Heikin Ashi candle closed. Let's go back again. Look at these Heikin Ashi candles. This one here, this one here. Look where they closed, as opposed to the regular candle. The regular candle closed here, closed here. So when that Heikin Ashi candle closes, you probably think that's where price is, but that's not where price is. Price is usually a little higher or a little lower depending on which way the market's trending and also the strength of the move. Now, sometime when the market's not really moving much and it's not that strong of a move, the candles will close pretty much the same as the market. All right, but here you could see the big difference. Heikin Ashi candlesticks, normal candlesticks. Also, we're going to look at this. This is a normal candlestick chart. So you could see the normal candlestick paints this big long wick candle, and that's a big rejection candle. But if we look at that same candle on a Heikin Ashi chart, looks like this, and it's an indecision candle pretty much. And then the market starts to slow down. Then you could see how we look at where the candles close. As you could see, these candles closed higher. Each high was higher, but this high closed inside this whole body. That's what I pay attention to. And then once the market starts making new highs again, and making a green candle, then we could get into the market again. But we're going to have a way to get into the market based on using Ichimoku, which I'm going to show you when we go to the live charts in a few seconds here. But let me first tell you some advantages of using Heikin Ashi. They're easy to read, they're lagging, and how could that be an advantage? Well, basically because when they're lagging, it helps you to get into the market much later, a little bit later. Therefore, you're not getting into a market that doesn't have momentum and help you to get whipsawed in and out of the market. So it keeps that from happening to you. It defines the trend for you. And as I said, it prevents you from entering a trade too early based off of that lagging. Less false signals, because once it paints a new green candle or a red candle, it signifies that there's momentum. All right. And they're great for a volatile market. Now, some of the disadvantages are they're elementary in nature. A lot of people think that they're just simple and basic, but that's what we want to keep our trading, right? We want to keep our trading simple and basic. We don't want to over analyze the market. We want to do as little as possible to understand the market and still be correct. All right. That lagging could be a disadvantage for you if you don't understand it and don't pay attention to it, because Sometimes it could lose some of your profit for you. Um, but a lot of times you won't lose a lot of your profit, because when the market slows down and starts moving the other direction, it doesn't usually just start with big momentum to the opposite direction, but sometimes it could, but it usually doesn't. So therefore, when it starts making smaller candles and um, indecision candles like the dojis, then price is pretty much the same as what it would be on a normal candle. Most charts, the formations are not valid. So when you look at formations, I mean, you'll be able to use triangle patterns and they'll pretty much be the same and everything. But maybe you use head and shoulders or something, and those may not be as valid. You may have some invalid signals. And then, as I said, you lose some profit when getting out late. But like I said again, sometimes that doesn't affect you because the market slows down and there's not that big of a difference between the candles when the market moves not that big. All right. So let's go right to the live charts and see and start to look at this. And I'm going to show you how to trade these with Ichimoku. What I use is the Tinkinson. So I'm going to show you how to trade those with the Tinkinson. All right, let's get to it. All right, so mostly on YouTube, I've been showing a lot of trades as far as like Kumo breakouts and maybe TK crossovers, but I'm going to show you a different trade, and I'm going to be using the Heikin Ashi candles, and I'm going to show you exactly how to trade. And I'm going to make some changes to the Ichimoku system because we want to be able to catch these trends and stay with the trend and get some nice bounces. So basically what we're going to trade is the bounce of this line here, this green line, which is going to be your Tinkinson line. But I'm going to make some changes to it, okay? The change I'm going to make is I'm going to make it, instead of using this Tinkinson line, I'm going to use the 9-period EMA. Now, I'll show you why I'm doing that, and then I'm going to talk about, you can also just leave it as it is. I'll show you a trade that I'm in right now where I pretty much just left it as it is. But this is, the red line is going to show you, this is the 9-period. There's not much of a difference, but there is one difference where I like to see. Now you can see how we bounce off of the 9-period a little bit smoother. All right, and you can see it doesn't flatten out as much. Now that's the big thing, because it doesn't flatten out. So looking at that 9-period, you can see it we're pretty much the same. Not much of a big difference, but look where we have this flat here. All right, and then look where we have a flat up here. So we never would really get back to that point right here, but see, if you're using the 9-period EMA, you're going to get back to that point, and this is where you're going to be able to trade. Now, you probably wouldn't have missed a trade anyway, because you could see how Tinkinson is coming down, and finally, before we even would have really gotten to the trade, Tinkinson, we would have been bouncing off of that level. So this trade is going to be what we call the Tinkinson bounce, okay? And you're going to follow a couple of directions here, instructions. But I just want you to still continue to look at, see how the 9-period EMA pretty much follows the Tinkinson. Now here's where a big difference was right here. You could see where it flattened out, where Tinkinson flattened out and then dropped. But you could see the 9-period stayed pretty close to price. Therefore, when we had that rejection here, we could have still gotten to the trade. And you could see how far away these levels were before we really would look to get into a trade. You might not really get into a trade because we're waiting for it to bounce off of Tinkinson, and it doesn't. It just stays right with it. So as far as when we're painting new candles and we're making new lows like this here, if we don't get in on this point, because what we're looking for is the market to pull back to Tinkinson and then show us the move again. So basically here, where you see this move to the downside, the market moved to the downside because it was red candles, and then you could see we had a green indecision candle and then this big candle here, and then not much movement. We want to put our entry below this level. All right, and then you could see where we had it close right here. That's the market we go to the downside. So I'm going to explain it more in detail. Let me go back to the beginning. So this is a TK crossover. Let's remove the Tinkinson, and we'll use on this chart we'll remove the Tinkinson. Alright, so let's remove this. and then we're going to use the red line. We're just using this Tinkinson sub is what I call it. So what you want to look for, basically, you trade your time frame, because we're going to go back through every time frame. I'm going to show you it's going to be the same thing. You're trading this crossover right here. So you're looking for this crossover with the Tinkinson and Kijinsen. Kijinsen is this blue line, and the Tinkinson is the red line, as we say. And they had a crossover right here. It was a bullish crossover because Tinkinson, the sub, went above the Kijinsen line. All right, and when you have that, that's going to be bullish. So now we're going to look for long trades from this point. All right, so we had a little bounce here. You could see where we had a bounce, and in the market turn, we had a green candle. That's an entry right there. So we want to have that crossover, and we're going to trade the direction of a crossover. It's a bullish crossover. And why are we trading below the Kumo right here? Basically because there's a lot of reasons. And I explained this more in my courses about trading below Ichimoku, Kumo, the Kumo, and trading above the Kumo and all that. But what major is that we're looking at this TK crossover. That's the main thing we want to see. We want to see that TK crossover. We're using the Kumo as basically just our support and resistance levels. All right, it's going to be a support and resistance level. You can see that flat top here. We had some resistance, but the market was able to get through it. But that's what we're using it for. Basically, we don't need to use it for the bias because we're using the TK crossover for the bias, and it's going to be a little bit quicker bias than what you get with the cloud, because the cloud, when you look for the overall bias, it takes quite a while for the market to go above that cloud. Then you change your bias. Our bias is changing when we get the TK crossover here. So we get a bounce right here. We get the green candles, and then we get a little small loss of momentum here, and then we get a red candle. A green candle, sorry, that closes above the red candle and bounces off of the Tinkinson, this Tinkinson sub, so we could get into the trade. All right, so a lot of times you may not be able to see that you should be getting into a trade. So if you can't understand and see, you're going to wait till you see something like this, indecision candles, and then a little, maybe a change of color. What we want to do is put a stop entry above that level. So we'll put an entry above that point. So it could be above this point, or it could be above the doji that you had here. All right, and then you're going to put an entry above that point and let the market trigger you in. You're going to use, well, I usually start out with this as my stop loss here when I'm starting to get into the market. All right, but you pretty much want to use fractal levels. I don't know if you guys trade fractals or not, but I use fractals for my stop loss. All right, and then you just follow market. Now, the way you get out of the trade, there's a couple ways we could get out of the trade. I'm going to go over those. One of the ways would be, let me go back to this. One way would be when the market comes up here, if it closes inside Tinkinson, we get a close below Tinkinson. That's where we want to get out of the market. So pretty much it's like Tinkinson is your trailing stop. And then the other way is, if the market paints a little doji, we're going to do this. So if the market makes a little doji here, then we would put a stop loss below that level, a little bit below that level. And if the market triggers you, then you're done. Or else you could get a close below Tinkinson right here, something like that. And I'll show you a trade that I'm in. So basically this is the Tinkinson Bounce. That's what we call this, Tinkinson Bounce. We're using the Tinkinson sub, a 9-period EMA, and we're looking to trade the direction of the crossover. So here you see this is a bullish crossover. We should be looking for only long trades. The market stays above the 9-period EMA, stays much above that Tinkinson, all right? And then same thing here. You got a crossover to the downside. That's bearish. So here's your crossover right here. That's bearish. Tinkinson right here crossed over your Kijinsen. That's a TK crossover. It's bearish, so you're going to look for trades to the downside. You have a rejection of Kijinsen, of your Tinkinson level right here. You're going to enter the trade. You could put a stop loss, your entry here with your stop loss up here. All right, so let me draw this one out for you. One, you could start your entry here. So you put that as your entry and put a stop loss above that point or above Kijinsen. All right, and then let the market trigger you in. But then again, the market moves higher and then makes this indecision candle here, a nice one to use. So we put an entry below that point with a stop loss above that level, but I like to use the Tinkinson, as I said, to start out. And then you would be triggered right here. That would trigger your trade, and then you would get out of the market pretty much when you get a close above Tinkinson. So you would have got out right there. The market moved from that point down to here for you, and then you had opportunities to get back into the market. All right, you could get back into the market here. Indecision takes you back into the market. You want to get out here. The market's not giving you a lot here because it's starting to change direction. So you could see it, what it does here. So you get all these hold on one second. You get all these candles here that were indecision. Nobody's really, you're not trading that stuff. You're sitting right on a line here. You're not doing anything. You want to start seeing the market give you better candles. When you get indecision candles like this, you're not getting into the market there. So you just draw a level and look for the market to break that level and start moving again. Pretty much we know we're not moving there, so I would pretty much draw a line here, and I'm waiting for the market to start moving past that point. Or I want to see the market get past this point, which will be these indecision candles here. I want to see the market get past that point. So I'm pretty much got the market in a little box here, and I want to see the market break out of that point. And there it does. We get a TK crossover here. Then you can see you got bounces. Here's a bounce right here. So when we get that bounce, let me draw it out. We're going to put an entry there with a stop loss. I usually start out there, but you could use the fractal level. And then finally you would have gotten triggered. You could also put your entry right down here as you just painted a new candle. And then you see the market would have triggered you in. Then you see these indecision candles here. You would have put an entry here. Stop loss, I like to be below here, but use your fractal levels. And then the market triggered you in. Alright, so that's looking at one pair. Let me go to a trade that I'm in right now, show you guys. I'm in a euro pound trade. Now, last week I said I made a recommendation for trading euro pound long, quite possibly, but euro pound long violated what I was looking at. So let's go back to that real quick. We were looking for something here to happen, for a change of direction, for the market to continue, because the market was pretty bullish, and it's still pretty bullish, but we're in a move where it could become strong and bearish because we just violated some levels that changed this market. But this market could fall for a good while before you really say it's broken the structure of this bull trend here, right? So this is just basically a correction overall. So I wanted to look for the market to keep moving to the upside, but it didn't. So I went down to the lower time frame and started looking at what the market was doing, and I could see an opportunity to get in the market off of the Tinkinson bounce, because we had a TK crossover right here. So when you had this TK crossover right here, you could see the market. Now we have other trades that we talk about, but I'm just going to show you this Tinkinson bounce trade. So I had a bounce right here. My level was right here. I wanted to get below this point. This candle closed and I opened up on the next candle. This candle here closed below the level that I wanted. So the level that I was looking at, I waited for the close. I put a level here because we had indecision bouncing off of the Tinkinson right here. Could see that Tinkinson, and I'm using the normal Tinkinson here. So here was my level where we were bouncing off Tinkinson. Then I had my entry here, and I entered on this candle because this candle was my entry. It triggered, but I waited for the close. When it closed, I opened up here, and then I'm still following. The way I'm going to get out of this trade is when the market closes above Tinkinson. So currently it's giving me 111 pips right now, and there's possibly a chance for more. And if it closes above Tinkinson, then I'll get out of the market. All right, so that's looking at the Tinkinson bounce trade. Let me look at a couple more pairs real quick. Look at the US dollar yen. You could see, I'm going to show you why you like to use the sub. This pair will show you pretty much. All right, so you can see why I like to use the sub, because I catch a bounce here that I would have never caught with this flat Tinkinson right here. And then the market moved to the upside. Then I get another bounce here, and you get all kind of bounces. And those are trades that you want to get into. So I'm going to remove it from here so we can look at it cleaner. All right, so now we're using the sub, and you can see the bounces. Here's a bounce here. There's another bounce here. A couple bounces here, and then this would have been a little harder to get into because the market's a little shabby right here. When you see this kind of stuff happening, be careful. All right, and then the market tries to take off a little.